This is Macro Horizons, episode 345, Angles of October, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery, to bring you our thoughts from the trading desk for the upcoming week of October 14th. As October 31st quickly approaches, and we're looking forward to the predictable sugar highs and lows, the only question that remains is whether this year's costume will be a friendly ghost, a piecemeal monster, or a dove in hawk's clothing. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the Treasury market did, to a large extent, precisely what one would expect given the lack of new fundamental information and the dueling concerns about ever higher asset valuations and a slowing job market. There's little compelling reason to think that we're overdue for a range break in either direction, and so an extended period of consolidation remains our base case scenario. The biggest debate, of course, is how long will the government shutdown last, and in conversations we've had, most anticipate that it will at least go through the 15th of October, if not all the way until early November. The prevailing wisdom holds that the limiting factor will be how long TSA stays on the job and whether or not airport traffic is truly impacted. Recall that that's what ended the 2018-2019 government shutdown, and we certainly have that on the radar, as it were. There's also the ongoing debate about whether or not the wealth effect will ultimately rekindle supercore inflation and make it more difficult for the Fed to justify normalization. As it currently stands, with the government shutdown and no official data flow, we struggle to envision a path that would lead to the Fed either pausing in October or December or needing to cut more than the 25 basis points that the market has priced in. Our base case in the shutdown is that it ultimately lingers into late October, if not early November, thereby distorting the economic data to such a degree that even at the December 10th FOMC meeting, the Fed and the market will not have sufficient confidence in the quality of the data to do anything other than a quarter-point move. As we watch equity prices move back towards record highs, there's the obvious risk of a correction to the downside. Now, the uncertainty in that regard is whether or not a bit of de-risking or a de-wealthing effect would rise to the point of becoming a monetary policy consideration. If it is a gradual decline in equity prices that is not associated with a particularly high spike in equity vol, we'll argue that monetary policymakers will look at that as a welcome return to more reasonable valuation levels. On the flip side, if it is a more dramatic sell-off that occurs in the run-up to the FOMC meeting, one would be remiss not to at least acknowledge that a 50 basis point cut could be in the cards. While this certainly is not our base case scenario, we're cognizant that a lot of the positive momentum associated with the outlook is linked to a strong equity market performance.
Well, it was a week in the Treasury market that was, frankly, always going to be defined by everything other than economic data. As a function of the government shutdown and even the data calendar before, taking into account the fact that the BLS would be unable to release economic data, really our expectation was that this week was going to be more about cementing this new trading range, bracketed between, let's call it 4.25 and 4% 10-year yields, as investors contemplate what an even hazier economic outlook means for the October meeting and beyond in terms of rate cut pricing, and how the shift lower in the labor market outlook changes the calculus for the relative attractiveness of duration at these levels. It goes beyond simply yields can't go up, so they must go down, but rather the fact that the macro narrative has now decidedly shifted toward a more pronounced recessionary angst, a dimmer look on the pace of hiring, and a general concern that the global economy heading into 2026 is probably not going to be in as resilient a place as it was throughout the bulk of the last several years.
And what's very interesting about the current dynamic is that we still have the backdrop of tariff pass-through that has yet to be fully incorporated into the U.S. inflation complex. All else being equal, there might be a case to be made that the Fed would slow the pace of normalization in the event of stickier pockets of inflation into the end of the year. But given the government shutdown, the Fed is going to effectively be flying blind into the October meeting, to be sure, and presumably the December as well. We're not expecting that the government will still be shut down when the Fed meets on the 10th of December. However, the distortive impact of the shutdown on the realized data will leave the Fed in the default position of cutting rates by another 25 basis points. There's been a lot of chatter about what it would take to get the Fed to move 50 basis points in October, although there hasn't been much pricing follow-through in that regard, at least not yet. 25 basis points remains our base case scenario, and as we ponder what it would take for the Fed to go 50, the most obvious answer would be a material downshift in the performance of risk assets over the course of the next couple weeks. While we continue to see record high equity prices, as you point out, Ben, there is a building underlying angst about the overall state of the consumer, particularly outside of the upper quartile. In the event that we see a downshift in spending at any point in the coming months, we suspect that that will further reinforce the building recessionary angst. It's also worth highlighting the conversations around the AI tech build-out. We know this has been a net positive to business spending. We know it's a CapEx story. We know that it has also supported lofty valuations in the overall equity market. All of this does lead to the natural question of what happens if this has gone a bit too far. The next stage is under delivery. Midweek, we did see a knee-jerk sell-off in stocks as a result of concerns that the AI-related cloud leasing margins were much narrower than the typical cloud margins, and that certainly rippled through the tech sector. Although we were surprised how quickly equity stabilized and, of course, eventually started to move higher. This is, without question, an environment in which the wealth effect is very much in focus, and we're reminded of the post-Liberation Day sell-off in equities and how quickly the macro outlook can shift.
And beyond the wealth effect, and frankly what it means for overall financial conditions, around AI valuations and risk asset valuations more broadly, there's another component of the AI debate that's worth having from a higher level economic point of view, and that's as it pertains to labor productivity and what that ultimately means for the level of our star, and then implicitly, just how restrictive monetary policy is at the current juncture. It's not a new idea that the general trend lower in terms of our star that has been happening for decades is largely a function of increased efficiency, higher labor productivity, which has in turn been driven by technological advancements and the fact that a single worker with the help of technology, us two excluded, can now produce a lot more than they used to be able to. Drawing that logic forward, and as AI is increasingly adopted, the question is, does the increased productivity resulting from the use of AI mean that our star is in fact lower? Will there be structural downward pressure exerted on wages, given the fact that it will no longer take as many workers to accomplish a task as it used to? Or is the more immediate concern from the market and the central bank's perspective the jobs that are going to be displaced by artificial intelligence? Now, at the end of the day, any jobs that are replaced by the machines will ultimately increase labor supply and probably have the same end result in terms of downward pressure on wages. But at this point in this specific economic cycle, but also as we contemplate changes beyond just the cyclical and as it relates to the structural, it's this question that is on many investors' mind and probably the mind of the Fed as well. It doesn't mean that we won't trade the headlines relating to AI profitability on an intraday basis in the near term, but this is certainly a factor to consider as we think about the market over a year's or even decades-long time horizon.
It does set up a reasonable debate between the macro horizon and the micro horizon because, as we know, on the micro horizon, we've already started to see a material slowing in the labor market. And if AI, or at least AI ambitions, are in fact curtailing hiring, particularly for entry-level positions, then this could be the beginning of a broader cycle that will ultimately create a headwind for wage growth and a dynamic that is complicated all the more by the administration's immigration agenda, Going into this point in the cycle, one of the concerns had been that the administration's efforts to curtail immigration would contribute to scarcity for frontline, low-wage, entry-level workers. On the other hand, this has all occurred with a backdrop of such uncertainty that firms might not be firing, but they certainly aren't hiring at the moment, which has led to the perception that the labor market has reached stall speed. Further complicating matters are the headlines out of Washington suggesting that the administration intends not to rehire all of the furloughed employees. Now, whether or not that can be executed legally is an open question, although the administration has proven comfortable pushing those particular bounds.
And the latest saga in Washington fits very much in the mold of prior government shutdowns. While no, there is no direct impact on the Treasury Department's ability to pay its bills, and so the potential for a late payment is not part of this particular round of discussions about what's going on in D.C., even before taking into account the potential for large-scale firing of federal workers, there is the growth negative impact of already implemented furloughs, and what that's going to mean for Q4 GDP. But again, from a bit of a higher level point of view, the government shutdown does circle back to what was obviously one of the big themes of 2025, in the potential shift not entirely away from dollars, but at least a reallocation away from treasuries into other currencies, simply given the fact that the global buyer base of treasuries no longer views U.S. sovereign debt in quite as rosy a light as was once the case. Sure, this isn't a debt ceiling episode, but nonetheless, the fact that an entirely Republican-controlled government can't come to a consensus on a budget to keep the government open is hardly a positive detail in the pitch to own treasuries. Sure, the latest debt ceiling episode was more or less a non-event, but this current government shutdown debacle hardly bodes well for the next time the debt ceiling comes around and the prospects for an early resolution to that process.
Politics in Washington have unquestionably taken center stage at this moment, and it will be very interesting to see how the polls develop as it relates to the Democrats holding up the shutdown, which is the narrative that the GOP is pushing and is important primarily because it will be a key input in estimating how long the government shutdown will last. If the Democrats end up polling well as it relates to the midterms, then it's safe to assume that the government shutdown will err on the longer side as opposed to assuming any quick resolution. There's also the air travel and TSA issues. If we start to see understaffed airports leading to travel disruptions, that in and of itself becomes an economic as well as an inconvenience issue. And recall that that was ultimately what led to the end of the shutdown in 2018-2019.
Why is it that government shutdowns always on a long weekend?
And Congress still gets paid. In the holiday-shortened week ahead, the Treasury market will have some data of relevance. We do have NFIB on Tuesday morning, which will offer the market some context for small business sentiment. We'll also see mortgage apps as well as the New York Fed's Empire Manufacturing Survey. And beyond that, however, the market will continue to a large extent in the data limbo that has come to define current market conditions. This creates an extension of the uncertainty associated with the shutdown, but it also limits any urgency for the market to break out, either bond bearishly or bond bullishly. While it certainly is not a dramatic call from a rates trading perspective, then in-range consolidation is without question the path of least resistance, and as we continue to see fresh incoming Fed commentary, investors will remain interested on any messaging associated with how the government shutdown is factoring into the Fed's thinking about rate cuts for the balance of the year and how to approach the first quarter of 2026. Taking a step back, we continue to like the Treasury market as an asset class and expect that by the end of the year, yields will have pushed through the bottom of the prevailing range, and we have penciled in 10-year yields ending this year at 385, with a more significant bid in the front end of the curve, as we anticipate 2-year yields will reach 325. Going into 2026, we remain constructive. However, we're cognizant that the direction of both monetary policy and the performance of the rates market will be contingent on the evolution of the real economy. In the event that once the BLS is back online and new data comes in, we learn that it's been an even softer patch for the real economy than expected, That would pave the way for a rate cut at each of the first few meetings in 2026, very quickly getting us back to neutral. The market has yet to shift to the point where there's an active debate about how far the Fed will actually go below neutral in the event of a further slowdown, but it would not be surprising at all if, as the government shutdown extends, the angst associated with the prevailing uncertainty increases and conversations turn to a sub-3% terminal in 2026. Obviously, that would be supportive of the front end of the market and speak to an ongoing curve steepening bias. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. So we asked AI to come up with a closing joke, and it offered, "The yield curve walked into a bar. The bartender says, 'Why the long face?' Yield curve replies, 'I'm inverted, and everyone thinks we're headed for a recession.' To be fair, we've delivered worse. The robots are coming for us all." Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.